I'm Mark Crumpton. You're watching Bloomberg West. Let's begin with a check of your first word news. Former President Bill Clinton says the work at the Clinton Foundation should continue if Hillary Clinton wins in November. In his statement, Mr. Clinton said he'll step down from the board of the Clinton Health Access Initiative. Also today, Donald Trump said the Clintons should shut down their charitable foundation, quote, immediately. Mr. Trump today promised to be, quote, fair but firm toward the estimated 11 million illegal immigrants in the United States. He told Fox News he isn't flip-flopping on his earlier hard-line position, which included calls for construction of a wall along the U.S.-Mexican border. A federal judge in Texas has blocked the Obama administration's order requiring public schools to let transgender students use bathrooms and locker rooms consistent with their chosen gender identity. The ruling applies nationwide. The judge said federal officials failed to follow rules requiring an opportunity for comment before such directives are issued. German Chancellor Angela Merkel, French President François Hollande, and Italian Prime Minister Matteo Renzi today promised to increase joint European security efforts in the wake of terror attacks. The three leaders spoke to reporters aboard an Italian aircraft carrier off the coast of Naples. The Garibaldi is leading the EU's migrant rescue and anti-smuggling efforts. I'm Mark Crumpton. This is Bloomberg. Bloomberg West is next.
I'm Ramy Inocencio in for Emily Chang, and this is Bloomberg West. Coming up, tech takes charge, why the sector is exerting more control in U.S. markets than at any other time since the dot-com bubble. Plus, the sizzling e-commerce startup behind the Great Wall that just cut a deal with Walmart to give Alibaba and Amazon a run for their money. JDcom CTO joins us ahead. And China's big plans for the new advertising age. MediaNet is just the latest ad tech company to be snapped up by Chinese investors. The company's CEO joins us later this hour. But first, to our lead. Tech stocks in focus with the sector exerting more control over U.S. markets than at any other time since the internet bubble. The largest tech stocks, we're talking Microsoft, Alphabet, Facebook, Amazon, seeing massive multi-year rallies, and the distance between tech and the next biggest group, banks, is close to its widest ever. Well, Bloomberg's Oliver Rennick is standing by with more. Now, Oliver, break it down with me. What's the S&P tech sector in terms of a proportion of the S&P 500 right now?
Well, Remy, it's getting to be about 21%, which when you look at the magnitude in terms of how much the percentage weight changes, it's not a huge swing in magnitude, but relative to the rest of the market, it is picking up a bigger slice of the pie. So you're looking at about 21% in terms of its weighting. You can see that in the white line here with the info tech, obviously the biggest one right now. You compare that to something like financials, where here in the light blue, it's been pretty much flat for that group throughout sort of this recovery and bull market we've had, whereas the tech stocks really have led the way. Especially recently, there's actually been a bit of a turnaround in the earnings reports, earnings numbers where tech has been leading. So you're looking about 21% for tech, about roughly 14, 15 for the financials. Those typically are the two biggest groups. You can see how this compares to 2000, right? So yes, this level that we're at right now for tech is a bit higher than it has been throughout the bull market. Still nothing quite compared to where we were back in 2000. But I want to bring up another chart here that's pretty interesting, which is looking at sort of the sales story, because of course there's obviously, this is a function of market cap. These companies are getting bigger. Market cap is obviously shares in price, so price is moving up. That's helping this. At the same time, though, you have to think about what's going on with some of its big leaders. Basically, Amazon, Facebook, Google, Microsoft, some of these companies that have been leading this charge in terms of that market cap expansion. If you look in particular here, here's something interesting. We're looking at Amazon. This kind of shows a divergence that's emerged within the tech group. So Amazon price to sales is like 60 times price to sales. That's obviously huge. Its valuations are very high. But I think part of the sobriety of this rally has been the fact that there are still pretty low valuations in some of these big companies. For example, you look at Microsoft, you look at Google, they're getting actually back to price to sales ratios down to 2, down to closer to 0, which is you have an S&P average of about 3. So there's not quite the same exuberance in some sense, and maybe that's why investors will look at this rally and not be too concerned about it.
Now, Oliver, the last time we saw tech stocks having such a dominant position was in the dot-com bubble. A lot of people, of course, got hurt there. But there's something different about this time around. Walk us through that.
Yeah, exactly. If you actually check this out right here. This is basically the story, I think, in one simple chart. So I'm going to get out of the way so you can see what was going back here in 2000, 1999. This is looking at a valuation gap. So your top panel here is the tech sector in the white, its valuation price to earnings in the past 12 months versus the S&P in blue. This is pretty amazing. The spread down here is at the bottom. But this is pretty amazing. I mean, look at how high the tech stocks were valued back in 2000. It's not even comparable to what we have today. Where you look at this line is basically flatlining. So you have about 20 to 21 PEs in the tech as well as the S&P. So things really aren't blown out of proportion. I mean, you look back at 2000, this is just crazy. You've got tech stocks trading 80 times 12-month earnings trailing, and it was building. It's hard to know when you hit that top. But I think when you're an investor and you look at whether or not things are overvalued, you see that flat line there, the blue overlaid with the white, basically the same. And then I've got one last chart here that's kind of showing the same principle. This is actually looking at those earnings, so boiling it down a little bit more sort of acutely when you look at profits. And again, this speaks to the idea that yes, things are pretty highly valued in some areas of the tech market, but still nothing incredible, especially when you think about whether or not earnings can provide a little bit of a backstop here. The blue line is showing you the tech earnings growth, EPS, on a quarterly basis. The S&P, this is what we've been following here the past year, this flat line in the white where the S&P earnings haven't gone anywhere. But tech, it's still up. It's up 25% since the start of the bull market. And I think that earnings backdrop gives people a little bit of encouragement when they try to consider valuations and whether or not things here are blown out of proportion.
Oliver Rennick, thanks very much. And it's interesting to note that ever since the bottom of the tech environment, ever since February, both the NASDAQ as well as the S&P tech sector have been up about 23%. So some amazing numbers there. Thanks very much. Turning now to Asia, Alibaba has been adding social features to its Taobao mobile app to attract younger customers, get them to stay on the app for longer, and to entice them to spend that much more money. That strategy may be paying off. Active monthly users jumped 39% to 427 million. And mobile revenue is up to $2.6 billion in the June quarter. People are visiting the app more than 7 times a day, spending over 25 minutes in total on Taobao. Compare that with about 9 minutes on Amazon's mobile app or about 16 minutes on Twitter. Now, joining me now, Bloomberg's Selena Wong. Now, Selena, some interesting stuff here. How were they able to do this here?
I mean, Taobao really started just as a simple eBay-like app back in 2003, but it's really evolved into something much different from what we think of as typical of e-commerce. I mean, Amazon's stats are far lower than Taobao's. I spoke with Vice Chairman Joseph Tsai, and he said that they have this very young base of users, and in order to really hook them in, they needed to add all of these social features. So you can join one of over 1,000 special interest groups. You can watch a live feed from your favorite blogger testing out your favorite makeup, or read the news feed. I mean, there's just a whole host of things you can do on it beyond e-commerce, and that's what keeps them coming back for more. Right.
Now, of course, a lot of U.S. companies want their own users to come back for more, but it seems like the numbers aren't really playing out on that just yet. Definitely an envy. What's the disconnect here in terms of U.S. companies versus Chinese companies?
You're totally right there. I mean, Facebook has for years tried to get people to shop on its site. They've added the buy button, tried all these digital storefronts, has not really taken off. Same thing with Twitter and Pinterest, and Amazon also hasn't made any major inroads into social networking. There's a whole host of reasons why there are all these differences, but a main one is that China has this enormous base that's growing of mobile-first smartphone users, and they're very used to these extremely crammed interfaces. To a typical Western smartphone user, it would be incredibly overwhelming. I mean, you look at the Amazon interface, it's just, one neatly beautiful product on the mobile app. And so because of that, the Chinese ecosystem, these tech companies have been able to put everything all together. You can look at WeChat, for instance, you can social message, you can book a taxi, get a haircut. And that's why it's been so hard to change the habits of the U.S. consumer.
Right. It's a clean in the U.S. perhaps, or in the West, versus cramped in China, I have to say. But if they want to put everything up against the wall to see what sticks, it's definitely helping that there. I do want to bring up a quote that you had from Alibaba's co-founder Joseph Tsai, talking about his comparison with Facebook. He says that on Facebook you're friending all of your friends, of course, because you already know who each other are. But in our case, we start with strangers and then use data to find a commonality of interest and then create a community around that interest. Do you think here in the U.S. or in the West that could make traction?
So I think what he's saying is that, an e-commerce site has all of these data points. They're able to mass it and group people into, what you buy, what you're interested, what you like. It's a little creepy, but that's why there are all of these flourishing special interest groups from, fishing or wedding planning, baby planning. In the U.S., Amazon, they haven't really tried to do this because, as I said before, they would really have to change habits. I'm used to going to Facebook to talk to my friends, going to Amazon to buy things, going Twitter to look at news and tweets. It's very, very hard to change these ingrained habits, and I think it'll take many more years for us to be comfortable transacting on these or social networking on other types of apps.
Another social networking site we should bring up is Snapchat. We do know that Joe Tsai has invested in Snapchat, but I guess he doesn't really want folks to know that. There's another quote here. He says that we do want to learn and understand how Snapchat is engaging with young users. We're just intrigued by the product and impressed with Evan Spiegel, the founder, and we want to be partners with him. But why doesn't he want people to know that they have this investment so much?
They just don't want to comment on it. They don't want to talk about it. They know the U.S. media, we're all over this. Alibaba and Snapchat, tell us everything about why, all these integrations. They just don't want people speculating on it. They don't want us to think that in the near term we're going to see this great partnership. What it really is Alibaba is a super long-term oriented strategy. Most of what Joe Tsai said to me was off the record, but what I can say is that they really are looking to see what Snapchat is doing, how they're able to hook in all of these young users in the U.S. and maybe 5, 10, 15, even 20 years down the line, all of this knowledge they're gaining from their U.S. investments are going to pay off when they come full force in the U.S.
All right, watch this space for sure. Bloomberg's Selena Wong, thank you so much. All right, now to today's revolving door in tech. Software company Tableau has a new CEO. The company just named Adam Selipsky to the top position, succeeding co-founder and current CEO Christian Chabot. Selipsky comes from the cloud computing division of Amazon. Shares of Tableau spiked 5% in extended trading on the news, but it is just a small recovery for the embattled stock. It had sunk 42% through Monday's close. As you can see there, Tableau is trying to transition its software tools to a cloud-based subscription model and is now grappling with slowing sales growth. All right, coming up, Asia's internet giants may be scrambling to diversify, but JD.com is laser focused on retail. We'll talk strategy with the CTO of China's second biggest e-commerce company next. Plus, India's biggest e-commerce startup is heating up, but not in a good way. We'll focus on the internal turmoil at Flipkart later this hour. This is Bloomberg. One story we're watching, Amazon may be the most valuable e-commerce company in the world, but regulators say there is a huge difference in the value it places on its intellectual property, depending on whether it's in Europe or the United States. In Europe, for example, Amazon claims the IP behind its web shopping platform is immensely valuable. It does this to justify the billions of dollars in tax-free revenue it's collected since moving its assets to Luxembourg a decade ago. But in the U.S., it plays down the value of those same assets to explain why it pays so little in taxes for licensing them. Authorities on both sides of the Atlantic are asking questions, with the IRS telling Amazon it owes $1.5 billion, billion in back taxes. Amazon maintains that it's following the law and is sued in response to that IRS request. We are expecting a decision in that case this fall. All right, staying in the industry, China is one of the hottest markets in the world for e-commerce. According to iResearch, annual online shopping volume by Chinese consumers may double to more than $1 trillion by 2018. One company poised to capitalize on that is JD.com. This is China's second largest e-commerce operator behind Alibaba. Earlier this summer, the company struck a major deal with Walmart, agreeing to buy its Yihaodian website in exchange for Walmart taking a 5% stake in the company. All right, joining us now from San Francisco to discuss how the company is positioning itself to take on the likes of Alibaba and Amazon is JD.com's Chief Technology Officer, Chen Zhang. Now, Mr. Zhang, first off, I want to ask you, JD.com is staying the course on its core retail, but we were just talking about Alibaba moving into, say, cloud, into social, into entertainment. Do you foresee any change similar to Alibaba in the near or midterm future?
Let me first thank you for having me. As for mobile particular things, I see your section. We have we are partnering with Tencent, the largest social media company in China. Over 800 million Chinese users use WeChat every day. The astonishing thing is 50% of their time are spent on WeChat. And JD's e-commerce platform was integrated right into the WeChat. And if you are a WeChat user, you don't need a JD account. You can purchase a product on WeChat with WeChat Pay, as easy as without leaving the app at all. So, giving an example, during the Singles Day on November 11 last year, 50% of our new users coming from WeChat platform.
All right, now let's talk a little bit more about strategy in terms of JD.com relative to Alibaba and other competitors. What makes your strategy better than your competitors? If I were an investor, for example, why would I want to invest in your company versus someone else's, especially when other companies are expanding into other areas?
We are the largest online retailers in China. We own 234 warehouses across China and over 6,700 delivery stations. And we provide the same-day deliveries to all major cities in China, and including the second-day deliveries. Last year, 85% of our orders are delivered within same-day or second-day deliveries. So this is tremendous speed, and the service is a tremendous asset for us. And also, we really emphasize on quality and authenticity. And that's actually, if you know, that's really an area people concerned about a lot. What we see a shift in Chinese consumers is moving away from price being the primary consideration when go online shopping. And quality, authenticity, and service became more important today.
All right, now in June, we talked about JD.com buying up Walmart's stake in Yihaodian. What are the positives that JD.com sees in terms of that deal?
Well, we were collaborating with Walmart on e-commerce in the area include continue building the Yihaodian brand and business. We were launching a Sam's Club flagship store on JD.com. We will pursue online to offline initiatives, and we will leverage one another's supply chain network to improve our product selections for our users across China.
Now, is the company considering any other kinds of partnerships or similar deals there?
We're always looking at how to service our customers better. And with Walmart deals, the leveraging each other's supply chain will be very important for us to improve the product selections. But we're always evaluating what's the best for our users and improve our user experience.
Now, Walmart gets a 5% stake in JD.com because of that deal, but what's the benefit for Walmart here?
Walmart get participating in the online e-commerce in China. That e-commerce in China, that is competition in e-commerce China is extremely tough. And for us as a JD.com, we are always look at it innovating and adapting to ever-changing user needs. And this is kind of the strength of a local company. And Walmart, by partnering with us, can participate in that fast-growing sector of e-commerce.
Now, just earlier today, Forbes came out with an article with the headline, you might have seen it, the headline saying that is a JD.com takeover brewing? I want to get your thoughts on that because in 2014, Tencent had bought up shares of JD.com as 15% there. Today, it's more than 21%. Do you think JD.com would be open to a takeover there?
I think the Tencent always see the value of the JD, have a confidence in JD, in terms of the way, the ability we're able to execute, to deliver the high quality customer service. And we have always have a strong partnership with Tencent. And we believe that's a win-win for both companies.
All right, let's talk about the future of e-commerce. You know, we're talking about Amazon with their drones, buying up their own planes to get their products across the countries and around the world. What's your forecast for JD.com? Any play in the drone region too?
Yes, so we have one very clear use case for us in our drone program. Today, most of China's rural population is not participating in the e-commerce, e-commerce phenomenon in China. One of the key reasons is the delivery cost to rural area is 5 to 6 times more expensive than the cities. And what we are doing is using our drone to deliver the products, the packages, to the village representatives. We have over 100,000 Chinese villages. And from there, the customer can pick up the goods, or the village representatives can deliver the goods from there. And we are not going to deliver the package to individual customers. We already have a pilot program in place in Jiangsu province who deliver packages to rural customers. And in the medium term, we intend to roll out this program to more areas in China.
All right, JD.com Chief Technology Officer Chen Zhang, we'll leave it there. Thanks for your time. Still to come, we'll continue with Asia's fast-changing e-commerce landscape later this hour and dig into the serious growing pains at Flipkart. And tomorrow on Bloomberg, don't miss our conversation with the mayor of Pittsburgh. This as the city gears up to be the testing ground for the first fleet of self-driving Ubers. That conversation at 3 p.m. New York time tomorrow. This is Bloomberg. The rally in chip stocks is beginning to take on historic dimensions. The Philadelphia Stock Exchange Semiconductor Index is up over 20% this year, following its 8th straight weekly gain. If that rally continues for a 9th week, then it would be the longest such streak since 1995. All this as the broader market remains flat. Strategas Research Partners writes in a report that this rally is a sign of economic strength, similar to the growth of railroad stocks about a century ago. Historically, strength in chip stocks has boded well for future stock market performance. And to a stock we're watching, Intersil shares climbing to their highest this year. That's after Japan's Renesas Electronics entered into talks to acquire the chipmaker for $3 billion. No agreement has been reached, and the talks may not end in a deal still. Renesas has said it is looking overseas for R&D acquisitions. Coming up, Yahoo's ad partner is selling itself to a group of Chinese investors for $900 million. We'll hear from the CEO and founder of Media.net next. And if you like Bloomberg News, check us out on the radio. You can now listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on Sirius XM. This is Bloomberg.
I'm Mark Crumpton. You're watching Bloomberg West. Let's begin with a check of your first word news. Congressional Republicans have issued subpoenas to 3 technology companies who either made or performed maintenance on the private email server that Hillary Clinton used while Secretary of State. The GOP's been stepping up attacks on Secretary Clinton's handling of sensitive government information that flowed through the server located in the basement of her home in upstate New York. Illinois Senator Mark Kirk says he'll hold a hearing in September on the Obama administration's delivery of $400 million in cash to Iran. Republicans have criticized the administration after it admitted the repayment of the money from a 1970s Iranian account was connected to a U.S.-Iranian prisoner exchange. The White House denies the money was, quote, ransom. Turkey's President Recep Erdogan is criticizing the U.S. delay in extraditing an Islamic cleric accused of masterminding last month's failed military coup. President Erdogan says the U.S. position on Fethullah Gulen is jeopardizing the country's strategic partnership. He plans to discuss the situation with Vice President Biden, who's scheduled to arrive in Turkey on Thursday. The U.S. has said it needs evidence that Gulen did something criminal. Sweden's prime minister says if the UK drastically lowers corporate taxes as it prepares to leave the European Union, it could make Brexit talks more difficult. British Chancellor of the Exchequer, Philip Hammond, has indicated he'd like to reset fiscal policy through tax cuts and other measures. I'm Mark Crumpton in New York. It is 8:30 Monday evening here. It is 6:30 in the morning in Sydney. I'm joined by Bloomberg's Paul Allen with a look at the markets. Paul, good morning.
Good morning, Mark. Well, trading is, of course, already underway in New Zealand, up and running for about 30 minutes now, and the NZX are looking good, up 0.25%. We're seeing some weakness, however, for Nikkei futures traded out of Chicago, and we're expecting a flat start here in Australia too on the ASX. But that's after a rather weak lead from Wall Street. We also saw oil down overnight, and for a case study of what a weak oil price does, look no further than Petronas Malaysia, out with earnings late last night. Malaysia's state oil company reporting profit down 96%. We'll have some other oil results out today as well, with Sinopec Shanghai and locally here in Australia, Oil Search reporting first half results as well. Take a quick look at the New Zealand dollar. That's up about 0.25% this morning as well, after comments from the Reserve Bank Governor Graham Wheeler saying he intends to lower the cash rate, but a series of rapid cuts is not justified. That's some of what we're watching around the region today. I'm Paul Allen for Bloomberg TV in Sydney, Australia.
This is Bloomberg West. I'm Ramy Inocencio in for Emily Chang. A group of Chinese investors says it'll pay $900 million for the ad tech startup MediaNet. But the deal to buy the company that provides technology to power ads offered by Yahoo and Microsoft may not be as cut and dry as it first seems. The consortium has plans to eventually sell the company to Beijing Matino Communication. That move closely resembles a reverse merger, where a private company takes over a public one, then bypasses the formalities of an initial public offering. Joining us from San Francisco to talk about this deal is MediaNet founder and CEO Div Tarakia. Div, great to talk with you. First question for you. Of all the companies out there in the world, why did you decide to sell it to a Chinese one?
So, firstly, thank you for having me. What an exciting journey it has been for us. The way this process got started was around the end of 2015, we got inbound interest from a specific US-listed company that was an adjacent space. And we'd been building this business since several years. We started in 2010. We decided to hire bankers, run a process. And in that process, we got incredible amount of interest. 7 bidders in the final process, in the final round of the process. And of those, we decided this one made the most sense for us. It had the right combination that we were looking for.
All right, and what was that right combination? What were you specifically looking for here? It's a cellular tower company, I understand.
So, we were not looking in the first place, right? So we wanted to continue building this business, but with this particular opportunity, we got the ability to keep growing the business. We got the ability to get upside as we continue to grow the business in various different structures that we can work out with the consortium and Chairman Zhang and Mitano. We get access to additional market that we would have never gotten access to. It's the world's second largest online advertising market. This year, it would be a $40 billion+ market. Next year, it is expected to grow to $50+ billion. Right now, Media.net's revenue almost entirely comes from the US. A small percentage of it comes from Canada and UK, and a small percentage of it from the rest of the world. And we felt that this would be great for the company, because without the right local partner in a country like China, there is absolutely no way that you could actually scale in that local expertise, in local relationships, and several local relationships will allow us to leverage our technology to grow within what is a large, fast-growing market, and yet at the same time less competitive and less sophisticated than the US.
Now, Div, the deal was structured a bit unusually, some would say. Others would say maybe a little bit more bluntly that it looks like a reverse merger. I want to give you the opportunity to comment according to those folks. What do you say to people who say it's a reverse merger?
So in a reverse merger, typically, we would basically get stock of the public entity. That's not what is happening here. What's happening here, and there's a reason why this transaction is structured this way. So Mitano wants to transition from being an old TMT business to becoming a new TMT business and a large global and scalable business. They've already got the plan. They've already got the funding lined up. But as a public company, there are lots of regulatory hurdles. It's a time-consuming process. If you're in a competitive bidding process and you have to go through a time-consuming regulatory process in parallel, there's a very good chance that you won't make it. And this was a competitive process. So the only way that they could have really done this was this particular structure where they first create a consortium, get funding into that consortium, buy Media.net entirely, and then once they get all the regulatory approvals within China, then basically it would become part of Mitano. And the primary difference would be that in a reverse merger, you basically have the private company getting the shares of the public company. That's not what is happening here. It's an all-cash $900 million deal.
All right, thanks. Now, last year, China's State Council basically made a call for more investment into the ad tech space. Some see it potentially as saying, you know, we need help. Can you walk us through how far behind the ad tech space is in China compared to the United States?
So I would say that happened for a couple of reasons, or that would have happened for a couple of reasons. One is online advertising as a global business is a massive, massive business. And even at that size, so depending on what report you read, somewhere between $160 to $200 billion this year, and growing double digits. So in China, it's growing even faster than the other developed markets. China has been, because of the natural hurdles that exist to go and enter into that market, especially for foreign companies, it is less sophisticated. It is behind the US. It would be at least a year or two behind the US, or maybe more. But at the same time has its unique set of challenges. I think the China mandate might not just be to grow within China, which is obviously great, but I think the China overall mandate long-term is we're going to see an increase in outbound investments from China for companies that are global, that have lots of scale, that have a real business model that's going to be long-term sustainable. And that's what Mitano and Chairman Zhang from the consortium want to do here, where they want to build a global business and not just a China business. The goal here post the transaction is to not only add China as a market, but also to double down on our US and your Western European strategies.
All right, very quickly, sir, what's the next thing for you? You are a serial entrepreneur. What's next?
Yeah. So my plan is to continue with these guys. And that was one of the primary reasons that when we had 7 options, and let me quickly talk about them. So we had options from the US, from Europe, and from China. The difference between the bid that we took in this particular deal and the highest US bid was about 20%. And the highest US bid was from one of the well-known PE funds. And obviously, PE funds would want to discount the value that they could give because they need to make some sort of an upside on their exit. So from a value standpoint, we thought that we were at the same point had we found a similar strategic in the US. The primary differentiator was all these different value adds in terms of being able to access an additional market, being able to get access to incredible talent that exists in China, being able to access their capital markets, which will allow us to grow both organically and inorganically, and look at deals of various different sizes. And across the next few years, we look forward to we've completed our first phase. We've had a great journey in this first phase. Now, as we enter the second phase of growth, we expect to multiply the business from where it is today. And I want to be a part of that, and I'm going to be a part of that, and so is the rest of my management team. We're going to get lots of autonomy, and we have a lot of upside that we can work out on various different deals with this particular China team.
All right. Media.net founder and CEO Div Tarakia, thank you very much, and congrats again on the deal.
Thanks.
All right. One of China's most popular selfie app makers is said to be planning its public debut. That's Meitu, and it aims to raise between $500 million to $1 billion in a listing on the Hong Kong Stock Exchange sometime in the fourth quarter of this year. That's according to sourcing by the Wall Street Journal. Now, back in April, Meitu said it was seeking a valuation on the private market of more than $3 billion. At the time, its apps had about 270 million monthly active users. Coming up, an inside look at the problems plaguing one of India's biggest startups. We'll focus on Flipkart as a downturn in funding hits this e-commerce giant especially hard. This is Bloomberg. India's largest online shopping service, Flipkart, is feeling the heat. Flipkart's regular town hall grew tense on Friday. That's after employees accused management of betrayal following hundreds of job cuts. Chairman Sachin Bansal countered that the departures stem from poor performance, saying he lost his own title of CEO for exactly the same reason. Now, this all as funding slows and competition intensifies for the company, with the pressure on from Amazon. Joining us live from Tokyo, that would be Bloomberg's Peter Elstrom. Now, Pete, first off, to what degree does Flipkart's problems actually showcase the general issues in tech over in India?
Well, it is a broader issue. This is a very dramatic meeting, as you mentioned. Flipkart has gatherings with employees once a month, and the co-founders have an opportunity to discuss any kinds of issues that come up. And this particular one did grow quite tense because employees were upset that many of their colleagues had lost their jobs. They had come to the company hoping that they were on this growth trajectory and they were going to be able to do very, very well. And Sachin Bansal was quite frank with them about how they had missed some of their performance targets and they needed to do better. And as you mentioned, he said the reason that he lost his CEO job was because of the performance targets. He's still chairman of the company, of course. But I think that was a pretty frank admission, and it drew applause from the employees in the crowd. Right.
Now, to what degree is it actually also an issue of funding? Funding is drying up there.
Yeah, it is a broader issue. There are two things that are going on in India. There was a huge boom in venture capital investments in 2014, 2015. It rose to about $15 billion. You're now seeing that taper off quite a bit, and that's squeezing a bunch of companies, Flipkart, other companies in e-commerce, and really the startup sector more broadly. The challenges for Flipkart are even more intense because of the targeting of Amazon into the India market. Amazon has said it's going to spend billions of dollars. It's hiring many employees. It's marketing very aggressively in the market. It wants to take a big slice of the e-commerce market in India. So that puts pressure on Flipkart and the other domestic competitors to be on the top of their game.
Yeah, of course, one company's problems, in this case Flipkart, is the possibility for Amazon here. What would they, specifically need to do in order to take advantage of Flipkart turning over?
Well, the market is growing very quickly in Amazon. The retail market in India is quite fractured at this point, even more fractured than in the U.S. So you need to be able to not just sell goods reliably and kind of get them to customers reliable. You need to have the infrastructure in place to be able to capitalize on that growth. Amazon has lots of experience, of course, in the U.S. They've done reasonably well in some other markets, but this market is unlike any other that they've competed in.
Now, how can Flipkart actually mount a response to Amazon? Can they?
Well, Flipkart has an advantage here. They're ahead at this point. They also have domestic knowledge that probably works to their advantage, both in terms of language, in terms of customizing apps for mobile phones. Recommendations make a big difference there, too. So they have a bit of a lead here, but they need to continue to innovate. They need to continue to expand geographically and add more merchants to stay ahead of Amazon in this market that is going to become a very, very important e-commerce market going forward.
All right, Peter Elstrom, stay right there. I do want to get your take on another story that we're following, and that's China-based smartphone makers in terms of having their sights set on the U.S., looking to steal sales from market leaders Apple as well as Samsung. But, do they really stand a chance? Bloomberg Gadfly columnist Shira Ovide is not so sure. She tackles this in her latest Gadfly column and joins us right here in New York. Now, what's the takeaway from that piece?
Yeah, so the takeaway from the piece is we've seen in the recent weeks a number of Chinese handset makers say that they're going to go after the U.S. So Xiaomi and Huawei in particular, which have done very well in their home markets, they're now saying they're going to go after the U.S. soon with high-end smartphones. And, the battle should be really interesting.
Right. The interesting part is in what? In terms of specs, in terms of pricing? I mean, how can Apple and Samsung defend themselves?
Well, Apple and Samsung in the U.S. right now, they basically divvy up the market, that they have outsized market share in the U.S. compared to their market share in the rest of the world. The thing that's interesting about Xiaomi and about Huawei is that they're making very high-end smartphones for not very high-end prices. So much more affordable than the sort of $800 top-line price we've come to expect from Samsung Galaxy and the iPhone.
Right, and of course with China's Xiaomi, Hugo Barra was on Bloomberg Television recently talking about their strong intent to get into. I do want to play a little bit of that. Hugo Barra speaking to our own Betty Liu.
We'll lead with social media. We'll lead with the channels that allow us to get in touch with sort of this young generation that's very enthusiastic about technology. So definitely going to make our way there.
Shira, if there were any Chinese smartphone company, do you think it would be Xiaomi that would be able to break in?
I actually think that Huawei might have a better chance in the U.S. They have this incredible expertise in telecom and in chips, which has allowed them kind of a pricing advantage that China's Xiaomi doesn't have. And so if anyone can really make inroads, it might be them in terms of the Chinese handset makers.
All right, Peter, I want to bring you in, too. What's your take on what's happening here with Chinese as well as U.S. smartphone makers and in terms of them trying to get in there?
I think the Chinese smartphone makers are going to have a very hard time in the U.S. market for a couple of different reasons. I think, first of all, you need to think about which of these companies is going to be able to aggressively move into the U.S. Xiaomi is using a business model that historically has just not worked in the U.S. They're trying to sell directly online, bypassing the carriers without subsidies. Historically, U.S. consumers like to buy from the carriers. They like to get that subsidy when they sign up for a contract. So selling direct to them online has been been tried many, many times in the past, and it's never worked. So I don't really see how that would be different. In terms of Huawei, I'd agree with Shira that they do have some technology advantages. They've jumped to the top of the Chinese smartphone market very, very quickly. But the name Huawei sets off all sorts of alarm bells in the U.S. for a variety of reasons, not necessarily all of them well-founded. However, I think the U.S. carriers are also not going to support Huawei coming to that market in a big way and give them the kind of subsidies that they need to be able to take market share. And when you look at the other two players in the top four in China, Oppo and Vivo, those companies just don't have ambitions to move into the U.S. market. So I find it hard to imagine. Having said that, the U.S. market is tumultuous. You've seen tons and tons of change, and I think Apple and Samsung's dominance there is a bit of an anomaly. It will be interesting to see whether they'll be able to stay on top.
Right. And I want to get your thoughts on criticisms about Xiaomi. A lot of people are saying that it's an all-out copycat of Apple. Do you think this actually has any legs to it?
Well, historically, Xiaomi did have some IP problems. When they were operating in China and they were getting started up, they did not have the kind of IP that a lot of other companies had. They bought their phones from contract manufacturers. That's changed, however. They went to Microsoft, which, of course, bought the Nokia smartphone business, and they bought a ton of patents from them. So I think now they have some IP. They'll be able to defend that. At the industry gatherings, you need to have your own IP to be able to defend yourself. So I think Xiaomi is actually okay on that front, but I think their business model is a real problem.
Sherry, what do you think? Any thought of threat of lawsuits if they tried to come into the U.S.?
Yeah, it will be interesting to see if there's really going to be an IP battle. We've seen kind of the smartphone wars, at least on the patent front, kind of cool down in the U.S. from the days when Samsung and Apple in particular seemed to sue each other every day.
All right, great. Thanks so much, Bloomberg's Shira Ovide and Peter Elstrom joining us from Tokyo. Thanks very much. Coming up, what happens to one of the greatest basketball players of all time after he retires? We will tell you all about Kobe Bryant, venture capitalist. Next, this is Bloomberg. And now to a story we're watching. Niantic had a big July thanks to the release of Pokemon Go. According to new numbers released by Comscore, Niantic recorded more active U.S. users in July than Snapchat, Twitter, or Pinterest. These numbers are good enough to put Niantic in 8th place in the category. Still, it remains to be seen whether Pokemon Go can keep these users engaged long-term, and data is beginning to show a decline in that engagement. Daily active users in particular have been in a slow decline since they peaked in mid-July. Now to another story we're watching. Kobe Bryant is an 18-time All-Star and winner of 5 NBA championships. Now he's adding something else to his resume. That would be venture capitalist. Bryant has teamed up with investor Jeff Stiebel to launch a $100 million fund called Bryant Stiebel. That's according to the Wall Street Journal. The two have worked together in the past, having made deals with 15 companies since 2013. They team up now to create the Los Angeles-based fund that'll focus on tech, media, and data companies and expect it to last the next few years. We'll see if he is as successful at venture capital as he was at basketball. And time now to find out who is having the best day ever. Today's winner is Instagram. The app has now joined the exclusive 1 billion download club over on Google Play. Instagram is the 19th app to do this and the 4th owned by Facebook to hit this landmark. One thing to keep in mind is that the download counter does not differentiate between unique installations, meaning one user could be responsible for multiple downloads. But still, this isn't an easy feat, especially when you consider Android itself only had about 1.4 billion users as of September 2015. And that does it for this edition of Bloomberg West. Tomorrow, don't miss our exclusive interview with the co-founders of Reddit, Steve Huffman and Alexis Ohanian. This is Bloomberg.